Welcome to Trade Ideas. I'm Jake Merl, sitting down with Jannarone, Editor-in-Chief of IPO Edge. John, great to have you back on the show.
Thanks, Jake.
So let's get right into it today. What's your trade idea?
So my idea today is a special purpose acquisition company, or a SPAC, and it is acquiring a company called KLDiscovery. KLDiscovery does something that happens all the time, but we probably don't think that much about it. They're basically doing data discovery when there's civil lawsuits. That's about 4/5 of the business. So this is a huge thing that's going on these days. If you go back to the 90s, there was all this paper, right? But now the amount of data on all of our different devices, it's just dispersed in so many different places that it takes some real firepower to collect it quickly.
So John, how exactly does this company work? Let's say, for example, if I'm suing someone and I need their information, do I hire this company? How exactly does it work?
Yeah, so what happens when there's a civil lawsuit, and most of this business is in civil lawsuits, one party will get to have discovery of a whole lot of information from the other party. And what happens, or what used to happen 25 years ago, is you just get access to a bunch of file cabinets, right? But the world's changed dramatically. So we're not just talking about email, we're talking social media, what's on my iPhone, iPad, BlackBerry, servers, whatever. And it takes a lot of firepower to collect this stuff quickly. So law firms and major companies will both hire KLDiscovery or one of their competitors to do this. They don't have the capability to do it internally.
So overall, it seems like a great opportunity, but why specifically do you like this company?
Well, I think that these guys are head and shoulders above the competition in terms of their growth prospects because they're very good at doing acquisitions. So these aren't always game-changing acquisitions. Some of them are tuck-ins, but they're adding on all this technology that's built them up so that they're able to offer way more than the other competitors do. And by the way, this is a SPAC, so there's a merger that's going to happen here with a sponsor, and the sponsor is run by a guy named John Ledicke, who is basically a legend in rolling up companies. This is what he does. So it's a real match made in heaven, I think.
And so in terms of fundamentals, what does the valuation look like right now?
So it's priced, I think, quite fairly. I mean, I think that when you do these SPACs, people have started to learn that they need to be priced that they're gonna go up. So it's a little bit under 11 times 2019 EBITDA, and that's considerably less than some of the competitors. So if you look at listed competitors or comps, I should say. So SS&C is a good one. It trades about 20% higher than that. So I think there's a real good amount of upside there.
And how much upside are you expecting?
Well, I mean, I think, I don't want to put too high of a target on it, but I think 25% is pretty good. And that could happen fast, I think within a year or so. I mean, if people just start to see the company, knock out a couple good quarters, I think the stock should rise. I mean, it could happen faster. I mean, sometimes these SPACs, as we've discussed in the past, will trade, they'll start to trade way up even before the deal's approved. People are excited enough about it.
So are you looking to trade only the specific SPAC or also the warrants as well?
I looked at the warrants, Jake, and in this case, I think I would just go with the common stock. I mean, when we looked at some of these others, like Thunderbridge, I mean, that was a really unusual situation where the warrants were just being ignored, and they were very cheap. But in this case, they're trading about where others do. So there's another one, Leo Holdings, which is Chuck E. Cheese, which we've talked about. These warrants are trading around the same price. So, I mean, if you want the extra juice, sure, but I don't think there's an exceptional value there like there was with Thunderbridge.
And over what time horizon do you expect this 25% upside potential?
I mean, I think within a year, but again, I would not be surprised if it happened faster. I don't know that this is going to rally before the deal gets approved, but my guess is that after the deal gets done, this trades very well. And you can look at some of the other very successful deals recently, One Spa World, which we may have talked about. I mean, that one's up 50% in just 6 months. So, if these things are done right, the returns can be fantastic.
And what would you say is the biggest risk to this trade?
I think that the biggest risk here is competition. When I looked at this, I thought, what's the moat? And there are two big competitors. And by the way, one of their competitors was taken out at a higher multiple a couple years ago too. So that's another reason to think there's upside. But if one of the competitors starts getting very aggressive, maybe they make a smart acquisition, that could be troubling. But again, I would go back to the fact that we've got a CEO at the company who has a very proven track record, and then the sponsor, John Ledicke, who's also a master at doing roll-ups. So I think it's going to be tough to compete with those guys.
And in terms of defining your risk, where would you put your stop loss?
I mean, if I started to see something, again, this would be because of a competitive threat. I mean, I wouldn't want to lose more than 20% on this. But remember, this is a SPAC, so if you buy this now, right, you know, this is, the downside is really $10 the deal doesn't get approved. You know, you get your money back. But in the event that it's approved and, you know, something bad happened, that's where I get scared. And you know what? All SPACs don't, you know, perform great. One, Waiter Holdings has been a disappointment. And, you know, so I'm not saying, you know, I don't want to be a cheerleader for every SPAC. You got to pick your battles.
Well, John, we'll see how it plays out. Thanks so much for joining us.
Thanks a lot, Jake.
So John is bullish on pivotal acquisition. Specifically, he likes buying ticker symbol PVT at current levels. He sees downside risk as low as $10 with 25% upside potential over the next year. That was John Jannarone of IPO Edge, and for Real Vision, I'm Jake Merl.